Hello and welcome back to Core Finance. I am Matt Brown. I'm joined today by Bryan Noble, who is founder of tradernoble.com. How are you today?
Great, thank you. Thanks for having me, Matt.
Always a pleasure. Now, starting off, the markets, they just won't go down.
They won't. Why? Well, the central banks are still pumping money in. There's no chance of the Fed hiking rates. We've seen with the long bond and the 10-year notes where they are. And until we get a sell extreme that breaks some serious levels, this is just a buy and dips. If we went back 10 years ago and we had a missile launch out of North Korea, gold would be up at 2,000. The S&P would have fallen, limit down, and yet it fell 25 points. And then suddenly the buyers all came in and risk back on again. So, the risk was off for 24 hours. So, and you notice every time there's a key event, it's very, very whole stage managed. Every time there's a key event, the market rallies into it. So we've non-farm payrolls tomorrow. We have a long weekend in the States on Monday. The valuations are ridiculous. I'm as bearish as hell long term, especially because there's no average earnings. But until the S&P really takes out the June-July low of 2,400, it's very hard to be short.
And that's the thing. It looks overvalued. We've had in recent weeks a lot of kind of bearish chats and commentators, wise people on the shows looking to short this market. But again, we're seeing time and time again, and if you look at the North Korea situation, we've seen this occurring over recent weeks. The shorts or the bears get excited, put the shorts on, and suddenly get taken out. So the next day, and it's incredible. And we saw the Asian markets yesterday sell off. Europe followed suit, but the US just keeps on wanting to push higher.
And the amazing thing is the Dow had an upside key day reversal yesterday in the middle of everything, like 250-point rally off the lows. S&P just missed it by 1 point. If you look at the 100-day moving average, it's kind of 24.25. We got down to 24.21 yesterday. Boom. That's probably the fifth attempt we've tried to break the 100-day moving average. So that's the first line of defense. Then below that, then you got the June and July low at 24.02 and 24.05. That's the second line of defense. And then the big one then is the 200-day moving average at 23.84. So we've three big supports between sort of in a 40-handle range. So unless it's going to take a lot to break the three of those. So I will be buyer into each of those supports, looking for 8 or 10 points. Then you get out and wait for the next news to come out. But the markets are becoming 24 hours. You think on Monday night when it was a bank holiday in the UK, everything's nice and relaxed, and suddenly you're going up to bed at 11 o'clock and there's a missile launch and all hell breaks out again. So suddenly that's that night's sleep gone because you've got to get up and deal with whatever positions have been executed.
And that's a key point certainly for traders when you look at holding positions over a weekend. And as you rightly say, we have Labor Day in the US, so it's an extended US holiday this weekend. How do you approach a weekend if you have positions on? Are you looking to trim back in case there is that event risk over a weekend?
Well, obviously the big event risk is 130 first with the non-farm payrolls. The way my blog runs, I generally run straddle trades in, so I'll have a buy level below the market and a sell level above the market. A lot of times the market will, if we get an extreme number on Friday, now in fairness, the last few payrolls have been a non-event, but if the average earnings surprise is one way or the other, you will get a reaction in the S&P. If your buy or sell level gets hit, then the market tends to go back to the mean, which we priced before we had the numbers released. And obviously then once it comes to 5 o'clock, 6 o'clock, then you're looking to scale back and have no position over the weekend, because I don't think the US are going to stand back and having spent the last 6 weeks in the States myself, I don't think they're going to stand back and let North Korea away with what they're doing, so without retaliating to some extent. But of course we don't know what they're going to do.
And over non-farm is your product of choice, the S&P.
Yes, and the euro dollar. So I mean, I write about 9 markets every day. If there's a silver position is executed beforehand, that's no problem. But generally with the markets, I'm flat into the number, flat into a Fed meeting. Just cuts the risk out. And the whole theme of my blog is to gain as many points you can for the least amount of risk. We've had a phenomenal month this month with the way, thankfully, the volatility is back. When we the VIX in the 9s for a few months, which is just unprecedented, it's not going to stay there. there. We're coming into the September rocky period. Also, we've got month end tomorrow, so there's another reason not to be short. But I think once we get into September, I can't see this 100-day moving average holding forever in the S&P. And you know, if the Dow can take out the 21,500, that's a big level for the Dow, and we close below it, then you know you've got at least safe levels to go short. But every time you thought it was to go safe this year, the market just come back and bit you straight away. So you've got to be very, very selective. You know, similarly with the dollar, you know, the dollar's had a massive move. You know, the euro from 103.40 low in January the 3rd, and everyone was bearish. The euro was breaking parity, and here we are 120. Now it's overdone the other way. So you know, we're outside Bollinger Bands. We topped yesterday 120.70. We've had a good sell-off since. And the amazing one to me, coming from Ireland, is euro sterling getting to 93 yesterday. It's just, you know, I had a kid studying in college in Leicester for a year, and sterling was 70. It was costing me a fortune to pay for education. So
thankfully it's moved back
yeah,
in your favour,
yeah.
and maybe that is the currency pair that will hit parity this year. So just looking ahead slightly, and you've touched upon it, and historically September and October are volatile times in the markets. Do you see a lot of volatility now, certainly in September and maybe October? Is this the time to be putting your straddles on to take advantage of that?
Well, obviously we've got the elections in Germany in September, which is another you know, something on the horizon to keep an eye on. Then we have Trump, who won't stop tweeting, which is great for traders. You know, he's been really good for getting moves going in the markets. You know, the volatility would spike from 9 to 16 or 18, and then it'll go back down to 10, 11 again. So we get these intermittent spurts, but we haven't had consistent movement in the VIX, because every time the VIX moves up, it just goes back down again with the market. So I think, you know, we've had our relative calm for a few months. We've also got the Fed meeting, we've got the ECB meetings. These are all key. You know, how are the ECB going to react to the euro 120? Can't see them being happy. I think the only central bank who's delighted with the strong euro is the Bundesbank. We're actually ecstatic with it. We're getting. But again, if you go back to January when Trump and Merkel met, they both said they wanted a weaker dollar. And anybody who ignored that were just getting hit, and sentiment was all one way. Now sentiment's all the other way against the dollar. I certainly wouldn't be buying the euro up at these levels, not given the political risk that's going ahead. And the one thing that I find incredible is the bund yields at 30, 35 basis points, 8 years into an alleged economic recovery is quite incredible.
Incredible. And finally, if our viewers want to find out more about you and what you do at tradernoble.com, do they just go to the website? Just
go to the website, sign up to the free trial. I'll send them on the platinum service for the week if they sign up to the free trial with all the updated emails. You know, if you follow I'm not trying to boast or whatever, but if you actually follow this commentary without emotion, you will actually make a lot of points, but you've got to trust it.
Understood. On that note, Bryan, thank you very much for joining us today.
Thank you, Matt.